Good morning, guys. Happy New Year.
Morning.
Happy New Year.
Happy New Year.
Anthony, I want to start off and just talk about Apple in particular. That's a stock, and I want to kind of cast a broader
Apple.
view.
I
know you don't.
Okay,
I know you don't, because I don't want to dig in specifically to Apple, but I want to say that from September 2012 to August 2014, that stock, in the midst of the iPhone run-up, was below $100 a share. It dipped down there, stayed down there. In retrospect, doesn't make a ton of sense. Couldn't the same thing happen to FANG stocks writ large, even if everything is okay, if sentiment just doesn't quite turn around entirely?
Yeah, I think what you're suggesting is a little bit of sell on the strength, and that's indicative of what we're seeing. So in terms of our checks for the fourth quarter, we're seeing strength in terms of e-commerce. The holiday data points were quite strong. Our advertising checks for Google and Facebook have been strong for the fourth quarter, but the market is looking forward. The market's always looking forward. And so I think there are a lot of investors out there who might be out there waiting for managements to give their outlook for the first quarter and for the full year. And so what's happened is really the stocks have tremendously derated. We haven't seen big earnings misses. We've just seen multiple compression. That's happened massively in 2018 for the likes of Spot, Snap, Amazon, and Netflix alike. But what I would say is let's distinguish between the deratings that have happened because of cyclical fears versus ones that are coming because you're losing share, or because of regulation, or because of waning engagement. I'm thinking of Snapchat, maybe even Spotify, or saturation in the OTAs. And so I'm looking for names that have value. You mentioned that, and we certainly see that in Facebook and Google in terms of value relative to free cash flow. Defensive and competitively positioned quite well. Netflix is one of those. And then ones that might be counter-cyclical. So AWS and Amazon, people underappreciate how sticky those cloud revenues are, and that's one of the reasons we like Amazon.
Brent, what's your read to start the year? Is it time to really pay attention to fundamentals, or does sentiment still have a hold of the market?
The fundamentals are very good. You've had a 25% sell-off in all these names since September. So we think a lot of the bad news is already reflected in the stocks. And as Anthony said, I think most investors are looking for Q4 earnings and the outlook for 19. We don't think it's going to be as bad. So we think this is a good opportunity to selectively be buying. Again, given the sell-off we've already had, the multiples. Now, when you look at rolling forward to 2020 numbers, you're starting to look at Facebook at 8 times EBITDA. I mean, these are really impacted multiples that reflect a lot of bad news. So our belief is that these big platform stories like Google, Facebook, Amazon are still going to weather the storm better. Even if we go into a slowdown, we are seeing a pretty material pullback in terms of numbers, mid 20% growth for the industry, going to mid-teens in 19. So you are seeing a slowdown in the fundamentals, but the multiples have already been reflected, and the stocks have already obviously sold off pretty materially. So we think it's an interesting opportunity.
I agree
Anthony,
with that
what about
completely.
Snap?
And I was just gonna say, Morgan, I would also add that let's look at the reasons why we've had sell-off in the markets, right? So you've had trade and tariffs, you've had rising rates. I mean, these companies don't have debt. They have tremendous amounts of free cash flow. So rising rates doesn't apply to them. They also mainly don't operate in China. So a trade war doesn't apply there. And so I agree that it's going to be more about stock selection going forward. And the other thing to note that'll be interesting about the year ahead is it will be the new IPOs. So many of your viewers might be tired of hearing us talk about the FANG names, but we're going to have Uber, we're going to have Lyft. And so we'll really be interesting to see how those IPOs do and how they get off the ground in 2019.
But Netflix is spending all this money, tens of billions of dollars on original content. I mean, we've seen those shares under pressure in large part because of a rising rate environment. You think that's a myth, that that's not going to be the case?
Well, Netflix, yes, is a little different because they have to access the fixed income markets. I still think on a relative basis, their need for capital is not something to worry about. You see those bonds trade fairly tight. With Netflix, it's more about, how are subs trending? And there's a little bit of concern. Some of the data is coming in, maybe mixed, and so it's a little bit of a referendum on that. I also think Netflix was a victim of hedge fund unwinds in the fourth quarter. But yeah, Netflix is a clear market leader. The valuation has always been challenged for me, and so we're in line on the rating. But I think if you could get Netflix at like in the 230s, that would be your, your floor and a really incredible entry point there.